Hello everyone, welcome back to another exercise series from our Managerial Accounting course. In this series we're going to be looking at Chapter 10 exercises. In this video we're focusing on the first exercise that we're doing, exercise 10-2A. So let's read the exercise together. It says, Larry Mattingly turned 20 years old today. His grandfather had established a trust fund that will pay him $120,000 on his next birthday. However, Larry needs money today to start his college education, and his father is willing to help. Mr. Mattingly has agreed to give Larry the present value of the $120,000 future cash inflow, assuming a 6% rate of return. So what's required here? Round your figures to the nearest whole dollar. A. Use a present value table to determine the amount of cash that Larry Mattingly's father should give him. Okay, so the first thing that we're doing is that we are going to calculate, basically, what would this $120,000 that should be received a year from now, in his next birthday, as the question says, what would that be worth today if we assume an interest rate of 6%? Okay, so let me quickly remind you of the formula. If we are using the table, that would be the present value, which we want to calculate, should equal the future value multiplied by the present value interest factor that we're going to find from the table. All right, so that's the basic formula that we're using. So let's substitute and see what we get. The present value, which is typically written as PV for short, should equal the future value, which is in this scenario $120,000. And then let's go to the factors table. If you remember from our lecture, we said that we have two tables. One of them, which is this first one here, table 1, is for the present value of $1. Of course, you can find these two tables in the appendix section just before the exercises of this chapter. All right? And the second table is for annuities, right? So the table that we should be using for this, because it's a single amount, is going to be this one, table number 1. And what we need to do is that based on the number of periods that you can see here to the left, denoted as N, and the required rate of return, or the expected rate of return, which is 6% in this case, we're going to look for the intersection point between these two. So this is going to be our present value interest factor. Okay, so we will copy that. That's 0.943396. Let me just write that down in my calculator so I don't forget. 0.943396. Okay, so that would be here multiplied by 0.943396. Okay. And now all you need to do is just run the numbers on your calculator, and you should get the present value. Okay, so I already have the present value interest factor on my calculator, so I'm going to multiply that by $120,000, and that gives me $113,207.52. So I'm going to round that up to 8. Okay. So that should be the amount that Larry Mattingly's father should give him today, right? So that's the first part, or the first answer, part A, already calculated. So let's see the second part. Part B says, use an algebraic formula to prove that the present value of the trust fund the amount of cash computed in requirement A is equal to its 120,000 future value. Okay? So basically, we are redoing our calculation, but we are using a mathematical calculation, right? So what I'm going to do here, based on the formula, of course, the question is asking us to do it the other way around. So I'll do it both ways just for you. So mathematically, our present value formula is present value equals future value divided by 1 plus the required rate of return, all to the power of n. Okay? So if we use that to substitute based on the figures we have, that's going to be equal to $120,000, which is the future value. Okay? All divided by 1 plus 0.06, which is the 6%, to the power of 1, so we're going to ignore that. Okay? Now let's see if we should get the same answer. That would be, on the calculator, $120,000 divided by, open a bracket, 1 plus 0.06, or you could just write that as 1.06 right away. Doesn't make a difference. And the answer I'm getting, again, is 113,207, but it's 0.54, and the question, if you remember, said that we need to round all of our figures to the nearest dollar. So I'm going to round up to $113,208, which is exactly the answer we got from the first part. Okay? If you want to do that the other way around, you can figure out if the $113,208 were to be invested at a rate of return that generates 6%, okay, or at a rate of return of 6%, would it get to 120,000? Okay, so I'm going to reverse that, or basically I'm going to reverse the formula and use the future value formula, which is as follows. Future value equals the present value multiplied by 1 plus r to the power of n. Okay? Substituting in this formula should give me the present value in our scenario is this. Okay? So $113,208 multiplied by 1 plus the required rate of return, which is 6%, so 0.06, to the power of n, and the number of years we have is only 1, so we could also, again, just ignore that. Okay? Now on my calculator, 113,208 multiplied by 1.06. In my calculator, that's giving me exactly 120,000.48, which is a rounding error. The closest dollar amount is going to be 120,000, so I'm going to round down in this case, which is the amount that we need to prove we got our answer. So using this formula right here, we can prove that if the 113,208 were to be invested for 1 year at a rate of return of 6%, it's going to achieve exactly the future value that is given to us, which is the value of the trust fund that should be received in 1 year from today. Okay? So this is simply our answer. طبعا, typically most of the questions that you're going to get in your exam most likely are not going to require you to use the mathematical calculation, but you definitely need to know this, okay? Especially the simple or the single amount present value formula, which is this one. Okay, let me use a larger highlighter here. Okay, so this is the present value of a single dollar amount formula, and this is the future value of a single dollar amount formula. Okay. Most likely you will be provided with the tables, and you're just going to use these right here. This is the present value calculation using the interest factors provided to you in the tables, or the factors tables, table 1 and table 2 that I just showed you earlier. Okay, so this is table 1 here, which is for a single amount, and this is table 2 for an annuity. All right, I hope that you found this video useful. This is how you solve any exercise that is similar to exercise 10-2A. If you have any questions, please feel free to drop them down in the comments, and I'll see you in the next exercise tutorial. Until then, take care.